Why do I care? Like, the Fed has it under control. They said they have it under control. They're going to support the market. The repo rate has not spiked into the end of the year yet. Like, why is this such a big deal for me?
Well, I mean, I'll let Mark chime in a second, but from my perspective, I think, one, it's this vague part of the market where I think people just assume it works. And I think the fact that the Fed is pumping in $400 or $500 billion in just to make it so we pass December. I mean, part of it is also, have you ever played a game, God, you put...
Ouija board?
No.
Twister?
Twister, thank you. We were talking about that earlier, and I totally spaced out. Yeah. Can be a lot of things nowadays. Twister, you know, like you put a fire here, out, and another one, and
or
eventually...
Like a
whack-a-mole. But eventually, you know, you just get so bent out of shape that it just comes crumbling down. So I think my issue is, we may have December in control. The question is, there's January, there's February, there's March quarter end, there's April, which is the Japanese year end. So I'm going to kick it over to Mark, and hopefully Mark can shed some light here and, you know, tone down my bearishness.
Well, and to be fair, like, Lale's been warning of this for a long time, and it did come to pass in September. So help us.
Sure. Well, so why does it matter? Well, there's an old saying at the front end that funding markets don't matter until they're the only thing that matters.
You guys
and then
are cool.
Nothing else matters. It's like the 15 minutes of fame that we've had, you know, over the last couple of months for people going out in the front end. But they say that because the funding markets, and especially overnight repo, is so critical to liquidity in broad financial markets. And if there's a problem there, that means that leverage doesn't flow. Borrowing and lending, overnight collateralized, the safest type of lending, presumably, that you can do, it means that credit creation ceases. It means that it's much harder to spend or hire or invest. And it frankly means that financial markets would have to deleverage because they lost one of the core sources of financing. So that's why it matters so much, and that's why the Fed was so spooked by what happened in September. They didn't envision it. They ignored signals that markets were sending about how the repo market was becoming increasingly fragile, and then they've thrown the kitchen sink at this issue to make sure that we don't see a resurgence of it again in December. And I think, by and large, with everything that they've done, they're going to be successful. Now, you're going to see repo spike on December 31st. I don't know by how much, but it's going to probably be somewhere on the order of 100 to 300 basis points. But it should be just for one day. And the big concern heading into this point in time, the end of this year, is that you could have seen repo become unhinged again. And then if it persisted for a week or two into year end, you could have seen broad-based deleveraging. That seems unlikely at this stage. And I think the Fed is probably quite relieved by that. You had a little bit of a litmus test yesterday. Same type of conditions that catalyzed the big repo spike in September, and the market got through it without too much stress. You know, only some slight repo pressure early in the morning. And so all of that, I think, is going to be, you know, quite confidence-inspiring for the Fed as they approach year end. Now, there are more medium-term issues, and I think, Lale, this is some of the things that we were talking about in the green room earlier that are a bit disconcerting about what September revealed about the repo market and what the Fed is trying to do right now to ensure that that doesn't happen again.